Joining me right now is somebody who's got the pulse on the macros as they are developing, somebody who very closely tracks what's happening in the economy. And of course, when I say the economy, the RBI is a foregone conclusion as well. Sajjid Chinoy is India economist with JP Morgan. Sajjid, good morning. Good to see you in the new year. Wish you a very happy 2015 from everyone here at NDTV. Thank you. First up, Sajjid, let me ask you.
Thank you very much and Happy New Year to you and the team.
Let me ask you whether 2015 we're going to see a changed fiscal priority from the government. That's going to be the big headline of 2015. You know, you and I have spoken about this in the past many times, the need for government spending. But more and more people that we speak to on our shows are now coming around to that view, that maybe the government needs to facilitate, or not facilitate, but step in with spending in a big way. To kickstart, investments and growth. What's your sense?
So I think I want to make 2 points. I think we need to separate the composition of spending from the aggregate envelope. There is no doubt that this economy needs a public investment stimulus. If you look at non-defense civilian expenditure of the budget in the mid-2000s, it used to be above 3% of GDP. In the last 3, 4, 5 years, it's fallen to 1% of GDP for a variety of reasons. There have been fiscal consolidation concerns. There's been state capacity issues about spending and executing that money on the ground. There are issues about implementation bottlenecks on the ground. So there is no doubt that in an environment where corporate balance sheets are stretched, banks have this legacy stock of non-performing assets, the private investment cycle will take time to pick up, as we've been saying for the last 2 years on your show. It is time for public investment to step in. However, I think the big caveat here is the challenge for the government is to have greater public investment without necessarily busting the fisc. I think that's very important. All of the good things that have happened to India in the last couple of years, last 6 months in particular, disinflationary forces, current account has come down very sharply, stem from the fact that this government and the government before took the very bold decision of undertaking much needed fiscal consolidation. So as I see it, what we need is a continuation of fiscal consolidation, but the savings that the government will get from oil subsidies, for example, and from other kinds of savings that they plan need to be redirected towards public investment. So I'm all for more public investment as long as we don't bust the fisc in the process. I just end by saying India's consolidated fiscal deficit is still well above 6% of GDP, which is significantly higher than most of the countries that have the same sovereign rating as India. So we need to be careful on that front.
Okay, let's talk specifics. Do you think the government will stick to 4.1%?
Yes.
When we get the numbers?
I think so. I think
it would have stuck to 4.1?
I think so. I think that I think it will. I think the mid-year economic analysis, which was an excellent overview of the economy, has said the government has every intention to do so. It's a challenging environment because, remember, inflation coming down is good for households and good for consumers, but it's not so good for the government because they lose what we call the inflation tax. So nominal GDP growth this year is going to likely be 10% or even lower. Nominal GDP growth 3 years ago used to be 14, 15, 16%. When nominal GDP growth is at 10%, of course tax collections will suffer. So the government is struggling on that front. There'll be a significant shortfall on tax revenues. And the impact of oil savings will really show up in next year's fiscal deficit, because this has happened in the last 2 months. Much of the oil money has already been spent. There was an overhang from last year's arrears from last year's oil money. So what the government will have to do to get to 4.1 is to cut expenditures, unfortunately. But I believe the importance of sticking to that number will warrant such expenditure cuts, and I think they will stick to 4.1 as they've been repeatedly saying.
What happens, Sajjid, if they decide not to cut expenditure and they report a slightly higher fiscal deficit number, and then for the next year they present a fiscal deficit number which is not lower than the increased number of fiscal 15, maybe even a little higher? What happens?
I mean, there are several things. I know it's very tempting to have a counter-cyclical fiscal policy, and I agree that fiscal policy in the last 2 years has been pro-cyclical, which is not what you would advocate. Typically, growth is below potential, and fiscal tightening is accentuating that. But remember, the level of the fiscal deficit also matters, and this goes back to this is not this government's issue. It goes back to 2008-9, where the central government fiscal deficit, which is tracking 2.5% of GDP, got blown out to 7%. And in 2010-11 and again in 11-12, when growth was riding at 8-9%, enough fiscal consolidation efforts were not made. So when you have a consolidated deficit of 6.5 to 7% of GDP, including contingent liabilities, that's still a very elevated fiscal deficit. So to the extent that we're going to increase that going forward, there will be questions, I think, from foreign investors who might begin to worry about the commitment to fiscal consolidation. And the reason I say that is, even though I have every belief the government's committed, why would we leave open those questions to either ratings agencies or foreign investors at a time when the world's going to go through a very tricky 6 months? There are many moving parts here. Our sense is, and yesterday's FOMC minutes reinforced it, that first rate hike in the US is coming at some point relatively soon. And that's going to mean the appetite and desire for emerging market assets may well fall. Now, in that environment, when we've been lauded around the world for lower fiscal deficit, lower current account deficit, very credible monetary policy, higher reserves, why would you want to risk that? So I think the challenge is, don't necessarily change the goalpost of the fiscal consolidation path, but redirect expenditures dramatically away from subsidies towards public investment, because that extra public investment will boost productivity and crowd in private investment. That's the approach I would personally follow.
You refer to the mid-year economic policy, and I want to just quote from that same sort of document. And I quote, "A case not just for counter-cyclical, but counter-structural fiscal policy motivated by reviving medium-term investment and growth may need to be actively considered." In a way, it kind of makes the way forward pretty clear, that the government maybe is actually thinking about, working with slightly higher numbers. I take in all your points as well, Sajjid, what you say. The level is also important, and you went back to the earlier years of high growth and spending wasn't curtailed adequately. But the point also is, as you also pointed out, that we adopted an expansionary fiscal policy because of the global financial crisis. It wasn't pulled back in time. Maybe that was a mistake. But we don't have high growth now. We have very low growth. So growth is actually a problem. It's not as if we are growing at 7.5%, 8%. So then what do you do now, right now, and at a time when nobody is ready to invest and take the first step?
So I think there are two things to keep in mind. The first is that, listen, if there's a small slippage in fiscal deficit, if 4.1 were to print at 4.2 or 4.3 because of exceptional circumstances, and there's a slight change in next year's number the year after, but there's a very clear path of fiscal consolidation over the next 3 years where the fiscal deficit is coming down, and the assumptions behind the deficit are credible, the plan to bring it down appears credible, I'm sure everybody will be fine. I think nobody needs to quibble about small things. But remember, we should not be in a situation where to boost growth, we're compromising macroeconomic stability. What India wants in 2015, you see the problem in the last 5 years has been, in the bid to boost growth in 2009 and 2010 and 2011, we lost control of the economy. The fiscal deficit ballooned, it was very difficult to bring it down. The current account deficit ballooned, inflation was very high, and we know what happened. So in the last 5 years, we've had to choose either between growth or between macro stability. We've never had both. What we want in 2015, 2016 is both macro stability and growth. And all I'm submitting is that if there is a radical change in the fiscal path, while that may help growth, might begin to raise question marks in the eyes of outside investors about the commitment to fiscal consolidation, and therefore engender that macro stability, at some risk. That's all I'm saying. What I'm saying is the government's got a wonderful opportunity next year where you don't have to choose between one or the other. The fact is, if oil is going to be at $50 or $60, you're going to save 0.4, 0.5% of GDP in your fuel subsidy bill. All credit to the government for deregulating diesel as well. You'll have some savings on fertilizer. The government's made a good progress on the direct benefits transfer. That's going to bring down your subsidy bill as well. So there are many efforts underway where subsidies will come down. You will find savings on some other programs. And what I'm suggesting is that saving, which won't be small, 0.4, 0.5, 0.6% of GDP, should be deployed towards greater public investment. This way you get the best of both worlds. You get much more investment instead of public consumption, and you don't necessarily create angst in the eyes of investors around the world who will be a little bit nervous about emerging markets in general, given what's happening around the world. I think that's the balance I'm trying to draw.
So you're saying that additional savings and redirecting spending, quality of spending, there is ample room to do all of that without actually raising the level of fiscal deficit. Is that what you're saying, Sajjid?
I won't say there's ample room. I'm saying that clearly with oil being at $50 versus $110, you clearly save a lot, potentially a lot on fuel subsidies. There will be corresponding saving on fertilizer subsidies. Every quarter we're getting closer to rolling out Aadhaar and direct benefits transfer, which means you actually derive deduplication benefits of what you were spending. So there were lots of leakages. So the combination of that and oil at $50 clearly generates some savings next year, right? And what I'm saying is that's a wonderful opportunity to redirect those savings to greater public investment, and this way you don't necessarily have to choose between the devil and the deep sea.
The media analysis also suggested that India has a fiscal flow problem, but not a stock problem, right? Because the ratio of government debt to GDP over the years has actually come down quite a bit, even though we've all spoken about the fiscal deficit being a problem. I mean, how would you look at this observation? And I'm just again tying this in with my earlier quote, which I read out to you, that counter-cyclical policy, even counter-structural fiscal policy may be needed.
Yeah. So again, debt to GDP has come off in India. But the dirty little secret is a lot of the reason why debt to GDP has come off in the last 5 years is because inflation is so high. And nominal GDP, as we discussed, back 3 years ago was 19%. So when you've got the inflation tax, what you essentially do is you inflate away the real value of the debt, and that's coming down. Now, to the extent that all of us believe inflation is finally going to get under some control for next year, what you will have is nominal GDP growth is going to be far more muted, and therefore you will not get that automatic reduction in debt to GDP. So I think we just need to be a little careful here. I think the mid-year analysis was excellent in respect. I completely agree with its findings that you do need greater public investment, but I'm not sure I would necessarily read into the document that greater public investment means greater fiscal deficits, because as we discussed, we're in a very unique situation now where India benefits enormously from lower oil prices, and maybe what the government's thinking is, without necessarily fundamentally changing the fiscal path, this just gives us an opportunity to be counter-structural in the sense that with growth below potential, let's boost public investment, not just consumption spending.
So the way forward then is basically to get to the number, you'll have to cut expenditure, as you said earlier, right? I mean, to get to 4.1, you'll have to. Your tax collection growth expectations were closer to 20%. You're nowhere close to that. Disinvestments haven't really gone through. Those are financing items. They get shown as revenue receipts. But anyway, you'll have to cut expenditure. And that's, you're saying, desirable, right? Even in an economy like this.
Well, I'm not saying desirable. That's an unfortunate consequence of the turn of events, and it's not the best way to go about it. But remember, we keep forgetting, we still have among the largest fiscal deficits in the world. And in an environment where macroeconomic stability will be rewarded, India has gotten rewarded for that fiscal discipline, as difficult as it's been. The fact is, we did not take the hard decisions on subsidies 1 or 2 or 3 years ago. And when you don't do that, then unfortunately you're resorting to cutting other kinds of expenditure. So I'm not saying it's desirable to cut expenditures, but there's no easy answer here, right? If you don't do that, the fiscal deficit will slip enormously. That's going to have an impact on aggregate demand, on inflation, and perhaps on the monetary policy framework, on the currency, on what people's perception of India is. So the government, doesn't have an easy option. So you pick the option that's least, evil, so to speak. And I think that's why I think the government said they want to stick to 4.1 to their credit, and I think they'll do that.
Let me just put you some of the other things which are happening. Take the power sector, for example, Sajjid, right? We heard recently the government wants to give a one-time option for private power producers to move away from tariffs which were found after competitive bidding to a more regulated structure, which allows for cost recovery. In the road sector, for example, we hear the government wants to provide viability gap funding up to 40% for annuity project. It was available in the case of toll roads, but now in cement, for example, the government is coming in, in a big way. They are inviting tenders. The government is, in some cases, changing the rules of the game because there is no other option, providing some sort of a leeway for the private sector so as to come out of the slump, right? I mean, it is doing new things, different things, which would have attracted a lot of flack had they been sort of done by the previous government. So wouldn't you say this government still has that credibility? If it sits down, explains to the rating agencies, to the markets, important players that, well, this is why we are doing this is why we maybe need to spend a little bit more, wouldn't they get their buy-in, or you think it will be very difficult?
No, again, I'm not sure what the government's thinking, and clearly, first I want to just compliment them because the government in the last month again has shown a real determination and resolve to pushing through on key infrastructure areas. We saw in the week after the winter session of Parliament, it's very determined to push through. So you had a series of ordinances. I think if the land acquisition ordinance becomes law, very positive. So the government's very well seized what the problems on the ground are. It understands the private sector is suffering on multiple fronts, a debt problem, ease of doing business, regulatory kind of risks, and it's working systematically sector by sector in trying to debottleneck those factors. So I think the government deserves enormous credit. Yes, it has moved incrementally, but it's moving incrementally in a very sensible, sustained manner, which is all the more reason why I would think, we just need to be patient. I think, in India, we've in a way become the T20 culture where, you have a new government in June and you want to see higher growth in August and you want to see higher growth in October. That's not going to happen. India is coming off a prolonged structural slump where you've got non-performing assets and banks, you've got a big legacy debt problem, infrastructure companies. Around the world, if you look at these balance sheet constraints, they take quarters and years to work themselves out. Where now the RBI and the government is putting in place the systems where over time this will work itself out, and simultaneously doing all those supply side reforms, whether it's land, whether it's coal, whether it's power, whether it's roads, that we've been talking about. So I think the financial community just needs to be patient here. That the macro stability has come. Who would have thought inflation would be tracking in the 5s? You would probably get some monetary easing. The rupee has stabilized. The current account's looking very good. You've got FX reserves. Nobody's talking about what's going to happen to India when the Fed starts raising rates. These are all very good developments. And on the back of this, it will be several quarters before this translates into higher growth. We just have to keep at it. So I think the impatience to jumpstart growth needs to be tempered a little bit. Give this government time, give it some space, and eventually I'm sure we will see a growth pickup, but it won't happen overnight. That's the simple point I'm making.
Sajjid, what do you think the budget, for the lack of a better phrase, will be a big bang event? It needs to be one of those real direction setters? Or, even if it is not, we're going to be okay and say, well, so much is happening outside of the budget. So what's your sense? Are expectations going to be quite high into this budget?
Yeah, the expectations will be high, but the devil's going to be in the details. And I think, again, 20 small, sensible things in the budget may actually in the long run be worth more than one announcement that may or may not happen. So I think, if the government can commit to more public investment in the budget, if you see progress in the GST, you're seeing we're moving away from product subsidies towards cash transfers. We're getting more tax clarity and tax certainty. There is a path for the GST. That would be a lot. The government's spoken about the Indian Financial Code that will be introduced in the budget session of Parliament, which is a very significant financial sector reform. If you see all these things, that's very good. And I think, so again, we shouldn't become a victim of our own expectations. I think the key is how do you balance fiscal consolidation with greater public investment. If the government can meet that balance, I'd be very, very positive of a budget like that.
A lot of the ordinances which you referred to and you said it showed the will that the government wanted to get a lot of these things through, they would need to get clear through the parliament as well. So I guess the next parliament session is also equally important, right? It will show the capacity to execute some of these. What's your sense on that? Because I mean in the Rajya Sabha it still only has about 54 seats or so.
Yeah, we have a very important... Yeah, we have a very important quarter coming up. I mean, even before the Parliament session, we may well get recommendations from the Expenditure Management Commission that talk about rebalancing expenditures, which will be important. As you said, the Parliament session becomes important. It will be good for the government to show legislative success in at least some of these fronts. Now, I know, I don't want to get into the politics of this, but the hope is that, in the time between the two sessions of Parliament, the government will have some success in convincing opposition parties that some of this really is needed. I think on some of these issues there's not much philosophical difference, whether it's on insurance, at least with some of the major opposition parties raising the FDI caps in insurance, or whether it's on coal. So yes, I think that will be closely watched, and I think that's where people expect that this government with this majority will have some success in converting these ordinances into law.
Sajjid Chinoy, thanks very much for your time. Great talking to you. Wish you a great 2015 once again. Thank you.